This is probably one of the most important lessons that you can learn as an investor. And this is not clickbait. This is actually what distinguishes investing from all other sort of activities like speculating and even gambling. It is really simple, but a lot of people miss this idea. And that is the difference between price and value. Now, Warren Buffett, one of the world's greatest investors, has this great one-liner that says, price is what you pay, value is what you get. And I remember actually reading that line when I interned at Deutsche Bank when I was in high school, and it just kind of hit me over the head as being really important and key. But at that time, I didn't fully understand what it meant. It would take me a little while longer, and I had to learn a lot more before I could really understand what that key phrase means. And again, this is what is going to set apart someone who becomes a great investor and can really understand the investments they're making versus someone who's just kind of going through the process of buying stocks and, they're playing the game of hoping the price goes up, but they don't really know what they're doing. And so let us get into it. Now, price should be thought of as perception. And let me say that again. Price is perception. That is all it is. It is the perception of value. It is basically an opinion. And so if you think about the stock market and what a market is generally, what is happening is that buyers and sellers are coming together. They are deciding upon a price to transact. The buyer thinks that the stock is going to go up in value because there's really only one reason to buy something, and that's because you think it's going to be a good investment. Whereas the seller thinks that the stock is probably going to go down in value. Now, there are a few reasons why you could sell something. It could be the case that you're forced to liquidate. It could be that you want to raise cash to spend it on something else. It could be that you found a better opportunity elsewhere. And so there could be a couple of reasons you sell, but to keep it simple, you sell a stock because you think it's going to go down in price. And so what is happening here is that there are these two people that have different opinions as to the direction of the stock. It's their opinion, right? And the price that is ultimately shown in the stock market is a sort of aggregate of all of these different opinions. Now, what an investor does is they need to understand not what the opinion is of the stock, but what is the underlying intrinsic value of the stock. And so by analogy, when I was in high school, we all got this opportunity to say something to the class. I said that they were all like stocks. And if they saw themselves as stocks, it would actually help them cut through the noise and kind of have a little bit more self-esteem. Now, I didn't say it in those words at the time. I did say something though, like the thing about a stock though, is that the price it trades at is the perception of value, whereas its real value is dictated by the fundamentals. Because at the end of the day, a stock is nothing more than a part ownership in a business. And so whatever that real value of that business is going to be what that intrinsic value of that stock is. My point in calling all of my high school classmates stocks was that the perception of who they are as a person is not going to be in their control. It's going to be at the whims of other people's opinion. You can't dictate someone's opinion about yourself. But what you can do is you can work on who you actually are as a person. That is your intrinsic value. And the point that I wanted to make was eventually over time, the perception of someone tends to align with the reality of who they are. And of course, in high school, everyone is very concerned about how they are perceived. Everyone wants to be perceived a certain way. There's lots of rumors that will maybe impact them. The same thing is happening in the stock market. The stock market is much like high school. There's a lot of gossip about certain stocks that will send their price down. Again, that's just like the perception of what's actually going on. Doesn't mean it's true. It could be a rumor. Sometimes there's something to the rumor. Sometimes there's not. And so that is the price. But at the same time, there's an underlying business, and the business can be growing. It can be doing really well. It can be acquiring more customers. It could be making more money. It could be improving its cash flow, its inventory, its product. It could be attracting talent. All of that is sort of the underlying value. And as an investor, it is your job to not get caught up in other people's opinions of the stock. It is your job to form your own opinion of the stock and to have that opinion most closely aligned to reality. So there's a lot of stocks that have a lot of opinions on them. It could get very contentious. People's beliefs about what's going to happen with Tesla. Are they going to continue to dominate EV? Are they going to be able to roll out robo-taxis successfully? What about robots? What about autonomous technology? People are going to have a lot of opinions about this. But the point as an investor is to not listen to those opinions, but to form your own. The same goes for the motley of different stocks that exist in the stock market. It is your job to analyze the fundamentals of the business and make a judgment. And if you are correct over time, that perception of value is going to mirror the fundamentals, but it is not going to be the case instantly, nor in the short run. In the short run, perceptions can run rampant. People's opinions of a stock can go all over the place. They can over extrapolate out a slight miss in earnings, thinking that that's the end of the company forever. They can extrapolate out a slight product mix. I remember at one point when I invested in Apple, this was over a decade ago, and I remember analysts saying that everyone who already wants an iPhone already owns it, and at this point, there's no reason to ever upgrade again. I thought that that was wrong, but that was very much kind of a common opinion at the time that once someone got a device, that was kind of it. Maybe they upgraded it every several years, but over time, the upgrade cycle would continue to elongate and that would weigh on their volume. I didn't believe that, but many people did believe that. And so it's these sorts of judgments that you need to make as an investor. And then of course, you need to be right. You need to be correct in your opinion. It is not just about not having the same opinion as other people, but your opinion ultimately reflecting reality. And so good investors understand the difference between price and value. They focus on value. They will buy a stock when its price is below its underlying value. And so if you want to understand how to do that though, and all of the other factors involved in that, make sure you subscribe to this channel because we're going to be talking about a lot of them in the future. But also watch this video here on competitive advantages because that is going to be one of the big things that allows a company to sustainably create value. And if you have any questions, go ahead and drop them in the comments below.